Good afternoon, everyone, and thank you for joining us. We would start in about 2-3 minutes, and thank you for joining us for this session today. All right, Miss Vinita and Miss Reena, should we start?
Yeah, Thagoji is just joining us in 2 minutes. There's some technical issue. We wait for 2 more minutes.
We'll wait. All right, no problem. Thank you. Miss Vanita, we can start now.
Co-founder of Association welcomes you to today's webinar on labor transition concept of we have with us Mr. Venkat Tyagarajan, CEO of Quantum Trend, Mr. Rohit Joshi, Senior Manager, True North Partners, and Bhavin Shah, Senior Associate and Libor SME for True North Partners. Welcome everyone to our panel on Libor transition. We are looking forward to an insightful session. Before we go ahead, let me take a moment to introduce Drip Capital to you. Like many of us know, access to finance continues to be one of the structural issues amongst the MSMEs. Drip Capital has been working with MSME exporters throughout the pandemic last year and continues to do so. We are a global trade finance company and offer post-shipment financing to MSME exporters in India. Drip works with over 1,500 sellers and 700 buyers across 80 countries. We have financed over US dollar 1.2 billion worth of international trade since our inception in 2016. To know more about Drip Capital and to receive a call back from us, kindly fill the form shared in the chat section right now. And without any further delay, let's just move forward for today's session. The financial markets are moving from Libor as the interest rate benchmark to using alternative risk-free benchmark rates. However, the Libor transition may not be a cakewalk for everyone. I'm sure a lot of us have the questions like how to achieve the transition, what should you be doing next, what happens to our existing and new loan arrangements. Let's get answers to your questions from our expert panelists today. I will now hand over the session to my co-host Reena Pabari, co-founder of CR Forex, who will introduce you to our speakers. Reena is a chartered accountant and a Forex consultant by profession with 15 years of experience in treasury and Forex risk management. She has previously worked with corporates like Schlumberg and Star TV. Over to you, Reena.
Thank you, Vanita. So far we used to feel that, okay, Libor is going, it will go one day. Okay, and then clients started getting letters from the banks saying 31st December is the cutoff. Now, what happens to my funding cost? What happens to my borrowings? What changes in terms of compliance, disclosures? And then they say that, the fear of a situation is more fearful than the actual situation. So let us understand it from our experts today on how to deal with this change. With this, I would like to introduce our first speaker, Mr. Venkat Tyagarajan. We fondly call him Thyaguji. And it's a name that doesn't need introduction, so I'll make an attempt. He's known as Tiger of Forex in the industry with his exceptional knowledge of FX markets and more than 3 decades of experience. He was with Reliance Industries Limited as Senior Vice President handling their Forex treasury before superannuating recently. He's currently Director at SYFX Treasury Foundation and CEO at Quantum Trends. And most importantly, he's an exceptional trainer and teacher and the most approachable person who can explain most complex things in a lucid manner. I request Thyaguji to take over the session and enlighten us on today's topic. Thyaguji is having some technical issue. We'll have him in 2 minutes. We are extremely sorry for the technical glitch. We'll start in 2 minutes.
Miss Reena, why don't we have some common questions regarding Libor? Meanwhile, Tyagarajan ji is joining. Like maybe we can just have those common questions known to audience and some viewpoints if you can share. Meanwhile,
Sorry, the new points on?
some known points on Libor or any common queries which audience usually
Rohit is a better person for that.
If I may,
Yes.
if I may, I was going to suggest maybe you can flip the order around a bit. Oh, there we go. I think Tyaguji has managed to join, so I'll step back again.
They say that great things in life take time. We are so honored to have you, Tyaguji.
Oh God.
Yes, sir. Please continue.
Oh, sorry, friends. Actually, basically, it's I think a transition from a participant to a webinar to a participant to a webinar. So the transition was really difficult actually. Now, of course, we are going to talk about the Libor transition. It is really my pleasure and privilege for me to be discussing about the Libor transition. In the next, actually, possibly, I think we have started a bit late, actually, 10 minutes. I am extremely sorry for that. Actually, I think we will try to cover as much as possible in the next possibly 90 minutes. And then at the end of the 90 minutes, I think you should be very well versed, actually very well comfortable with what Libor transition means to you, as simple as this. So, what is Libor transition all about? That's a basic, the first question that comes to your mind, actually. If you have a portfolio of FCINR derivative transactions, let it be a currency swap, anything for that matter, and then outstanding FC loan transaction, every one of us has outstanding FC loan transaction, be a exporter or a be importer, actually everybody has, and then trade and supply chain transaction denominated in foreign currency. So most of the FX market participants will have either of these three, actually, so to say. So naturally, all of us all of these people are exposed to Libor as well. Actually, Libor is a household name as far as India is concerned. Actually, it brings to me what Winston Churchill talked about Russia in World War II. He told it is a riddle wrapped in a mystery inside an enigma. Something very similar to that. Actually, Libor transition is also a riddle wrapped in a mystery inside an enigma. But of course, Winston Churchill was talking about one particular country, whereas here actually we are going to transit from multiple IBOR in multiple countries with multiple risk frameworks. So I think it's going to be some sort of a unique financial event as far as the global financial markets are concerned. If you think of 4 game-changing events in the past, one is of course, German unification, and then adoption of euro, and then you talk about Brexit, and then you talk about pandemic. The former two actually it unified the world or unified the particular country or a continent, and then later two, let's be the Brexit or a pandemic, actually possibly it made divergent paths for each of these countries, each of the continents and each of the countries. Actually, everybody followed their own paths. Now, what is going to happen to the Libor transition? Possibly, I think I will rank Libor transition almost equal to these 4 events. So, what we are embarking from, let's say, 31st December 2021, nobody knows. That is where actually the knowledge comes to help, actually. So, we will talk about the Libor transition and what has happened in the next, let's say, 20 minutes. And then briefly, I will cover the broader contours so that the finer points will be taken up by Rohit and Bhavi. So, we are going to talk about the introduction, actually, alternative reference rates and transition process, and especially the Indian context in that is transition in the Indian context. So, of course, we all know actually, of course, we have been using Libor for years, actually, for decades. But of course, how Libor came into picture, actually, that is what it is interesting. That is, can you believe that Libor was born on the same 15th August of 1969, and then from there, actually, it graduated into organically graduated into some sort of a official reference rate where actually British Bankers Association started publishing, and then of course Libor became embedded in each of the financial transactions in the 2000s. So Libor now underpins, of course, you might have heard about a lot about Libor transition and how it has happened and all that stuff. $400 trillion worth of loan, bond, derivatives, and other financial instruments revolve around Libor. And then how the Libor actually basically it never represented what has been the market rate. That is where actually the alternative reference rates came about actually. So of course there is a history behind it. I think from 2014 it has been evolving, and on March 5, 2021, the cessation announcement came, and then actually Libor expiry of Libor was being made certain. And of course, where I will see Libor, that's a basic thing. Actually, I don't have any Libor exposure. This is a normal response from any corporate that you come across. But when you dig your books, naturally Libor exposure is there in some form or another form in books. Actually, possibly you might be having an interest rate exposure, and possibly you would have even projected Libor, possibly taken the future projections of Libor, and then possibly you would have given the cash flow projections for the next few years to operations. So at every point of time, actually, honestly speaking, there is no business which really is there without having adopted Libor, actually, as simple as this. So if you dig your books, you will find Libor, actually, as simple as this, whether you know it or not. And then why this, the entire exercise? That's a one question that comes to the mind. This is actually Libor it became susceptible to manipulation. Of course, whether it is manipulated or not, that is another thing altogether. It is susceptible to manipulation. And a $500 million market deciding the fate of 400 trillion, actually, that naturally, it is not reasonable, actually. And then liquidity of the underlying market, actually. As the liquidity underlying market died, naturally, there is a need for a representative reference rate, actually. So, challenge to Libor as a risk-free rate. So basically, the time has come for Libor, actually Libor transition. Actually, we are going to go from Libor to an alternative reference rate. That is for sure, actually. And now, right now, actually, even after 31st December 21, it is not that Libor is going to go away from every book, actually, possibly, as you see in this graphic. It's about 52 trillion of 400 trillion in financial products will still be exposed to Libor after December 21. Now we will talk about the alternate reference rate. Actually, Rohit will be giving you more color on this alternate reference rate. I am just saying, we started with Libor, and Libor actually, why we are going from Libor to other alternative reference rate. That is what we saw, a susceptibility to manipulation. And people thought that should be a representative rate and more than a some sort of a pooled rate or estimated rate. So that is where actually possibly we are graduating from Libor to other alternative reference rates. And then these are all the alternative reference rates that are being talked about, or possibly I think that are being planned. Now the major question actually basically if somebody comes and asks, okay, I am having a Libor exposure and what am I to do on 31st December 21 and what am I to do right now? Actually, that's a basic question. Now SOFR. Now possibly the SOFR first, that is the principle right now, and naturally the Libor is going to change into SOFR. The life is not so simple. That of course we will be going on seeing that, where actually you replace Libor with SOFR with possibly find and replace a button and then be happy about it. It is not going to be as easy as it is being made out to be actually. So there are some financial contracts which reference to Libor. They do not envisage, they never envisaged a permanent or indefinite continuance of Libor. That's a big question actually. There have been so many financial contracts which are having an embedded Libor risk. How you are going to change from Libor to SOFR? That's a basic question. And now, what is this SOFR all about? Libor, we all know actually, the banks are estimating what is the kind of the interbank borrowing rate that is right now going on that particular maturity, and then possibly it is getting pulled, and then various methodologies, and then we are coming, and then we are printing a Libor of that particular day. Here SOFR, it is a overnight secured reference rate administered by New York Fed that broadly actually basically measures the cost of borrowing each cash overnight with the US Treasuries as a collateral. As simple as this. Of course, you all would have seen how the reverse repo, actually the volumes have been going higher in US and possibly at right now at the 0.05. Actually, that is where actually the Fed takes the reverse repos and then 0.05. That is where actually the overnight SOFR is almost going to be there actually. So, but still, there have been so many instances where actually there have been unexpected spikes of actually how Libor and SOFR are structurally different. Of course, Rohit also will be discussing about this, but how Libor and SOFR is going to be structurally different. Libor actually, whereas SOFR is a risk-free rate, Libor actually, it has a risk element built into it. And then SOFR actually, there are limitations in SOFR. Basically, the unexpected spikes normally happen. Of course, nowadays actually the interest rates are closer to zero, so naturally you don't expect interest rate volatility to happen right now. But you can't say because the things can change very fast. And then possibly if you go back to September 2019 and from SOFR moved from 2.14 to 5.25 in a single day. Naturally, if you are going to be linked to SOFR, naturally on that particular day, naturally you would have paid 5.25% as interest cost. So naturally you are going to have a problem with the unexpected spikes. And then of course, liquidity actually it has been improving. Of course, it has been improving for sure. But still, the kind of liquidity that you used to see in Libor, it is not there in SOFR as of now. Actually, the market is evolving. Let's put it like this. And of course, you see these graphs actually, the way in which actually SOFR volumes have been, of course, the volumes have been going higher, naturally, reverse repo. And now the kind of money that has been there, but the kind of actually the debt ceiling problem, actually, the treasury has been spending the money, and then naturally it has been there has been an enormous kind of liquidity that has been pumped into US markets, and that's why you see around $1 trillion of reverse repo that is being done, and that about 0.05% actually. But right now, if you see the another graph, naturally from Jan 21, the open interest in short-term interest rate options and futures, SOFR moves to the main stage. Actually. Now we come actually basically, okay, I understand actually Libor is going to be replaced with SOFR. Predominantly, that is the case. And then what is that? It is going to happen. Libor, actually, I am going to pay Libor plus spread as of now. I am paying Libor plus spread as of now. I'm going to pay SOFR plus spread. That's all. As simple as this? No. It is not as simple as it is being made out to be, basically, because you are going to pay the adjustment spread. Adjustment spread, which takes into account the structural difference between the Libor and SOFR. So the Libor in principle can be, of course, just to understand, the Libor can be, in principle can be explained by three components. That is credit risk premium, term premium, and risk-free rate. In contrast, RFR actually risk-free rates are considered nearly risk-free and do not incorporate the credit risk premium and term premium component. That is where the adjustment spread comes. Now, this is one part of the story that we should understand. Okay, Libor is going to be replaced with SOFR, and then Libor, it is not going to be actually whatever that Libor that you are seeing right now, it is not going to be equal in nature, and then you are going to have SOFR plus credit adjustment spread. These are 2 points that we have understood right now. And then the fallback protocol. And then naturally, what all things we have? 3 things that we discussed earlier. That is loan transactions and derivative transactions, and then your short-term supply, let's say in Indian parlance, short-term suppliers credit and buyers credit. So basically, if I even name it, of course, it is not generic as such. ECBs and currency swaps, and then buyers credit, suppliers credit. These are all the 3 major components that have a Libor component. Now, right now, what we are doing, the fallback protocol is put in place by ISDA. In wherever actually possibly, this is basically ISDA comes into the picture, possibly in the derivatives. So wherever your currency swap is, wherever you are, the fallback protocol that comes into the all those derivatives. What is that fallback protocol? It's some sort of actually, it is a seat belt. It can prevent serious injuries in case of a crash, but it is much better to avoid a crash. That's the thing. And similarly, the protocol, actual protocol is the uniform procedure that is being followed across the industry. Similarly, the syndicated bilateral business loans are also expected to fall back from Libor to SOFR. And then the ARRC's recommended updated fallback language that is going to be used. So basically, the 2 things, basically ECBs and suppliers credit, buyers credit, and then derivatives. Derivatives are going to follow the protocol, and then this is going to follow the ARRC's recommended updated fallback language. So there are 2 approaches. One is hardwired approach, and another is amendment approach. Hardwired approach actually establishes SOFR as the most likely replacement. Actually, there are so many replacements or alternatives available, but still we are thinking SOFR is the most likely replacement, and possibly the only replacement, possibly going to be the only replacement of US dollar denominated LIBOR actually, where actually hardwired approach considers SOFR as the replacement. So when you consider SOFR as the replacement, mostly everybody is going to go with the hardwired approach. So naturally, if you are paying LIBOR, you are going to pay SOFR plus adjustment spread for sure. And now I just see this adjustment spread I have been talking actually. In the last few days, what has happened? What is the USD LIBOR? What is the term of actually 1 month? Let us say 1 month LIBOR. If you are taken, let's say 3 months LIBOR, actually we normally used to take bias credit, and then 3 months LIBOR it is 0.12388, and then term is and then what is the kind of differential between ARS recommended 0.26161 and what is happening between USD LIBOR and term SOFR. So right now, actually, the ball is in the corporate court, actually, basically what I have to do with the bank, actually. So what is the kind of replay? Of course, Rohit and Bhavin will be talking how we should talk to the bank. Actually, this is one thing. The only thing is, what is that you are replacing my LIBOR liability with? Actually, whether you are going to have the SOFR, what is the kind of adjustment spread that you are placing? And what is the kind of money that I am going to be charged? So these are all the three questions that normally you should ask the bank. And then there are some other alternatives. Actually, they are getting popular, but it is not as popular as SOFR. Right now, we will go with the assumption that SOFR is going to replace most of our LIBOR exposure. And then how I manage the transition. That's a basic point. Actually, now the simple questions that come to my mind, and actually which normally people ask, can I continue to transact in the USD LIBOR after the end of 2021? Of course, actually what they are saying, regulators are saying, they should cease entering into new contract that use USD LIBOR as a reference date, not later than 31st December 2021. That is, if you are going to avail a bias credit on 1/1/22, naturally you are not going to use LIBOR, but you are going to use possibly SOFR, as simple as this. What may happen to my LIBOR contracts prior to LIBOR ceasing or becoming non-representative? As long as LIBOR continues to be published as the representative rate, there is unlikely to be a direct impact on your exposure. Would LIBOR be published in some form after the cessation date? That is 1st January 2022. Of course, there's a timeline of where actually continue the publication of GBP LIBOR and LIBOR in the 136 month turn up for some time after 1st January 22. However, it is a synthetic rate. It is not a representative rate, actually. So basically, in our own interest, actually, it is better to move from LIBOR to whatever the alternative reference rate come 1/1/22. And what happens to my hedges? This is a serious question, actually. Let us say you are taking a ECB, and that where actually it is a floating rate liability, LIBOR liability, and then naturally you are taken a IRS where actually you are receiving floating rate. Then how do I marry my hedge and my loan? If my loan goes into SOFR plus adjustment spread, naturally my hedge also I should receive SOFR plus adjustment spread. That is where actually a professional help is required for a corporate to negotiate with the bank. And then transition challenges, of course, both the CFOs as well as banks also have their own challenges, and CFOs also have their own challenges. There is no way a banker can adequately explain the scope and breadth of the required amendments for a particular deal effectively. So naturally, everybody is confused. Actually, honestly speaking, nobody is very, very clear about what is going to happen. Actually, first from Jan 22, and then what all things happen. That is actually, it is unknown that we are entering into. There are three concerns. The first concern is the need to transition existing financial instruments away from LIBOR based on the fallback provisions set forth in the legal contracts. What has been the fallback provisions? How you are going to go from LIBOR into new alternate reference rate? And then second is the market risk inherent in restructuring the hedged financial contract. The same example which I am saying, where you are availed the ECB at a floating rate, and then you have hedged yourself by doing IRS, and how you are going to marry both, and then see that you are insulated from the interest rate risk. And then, of course, the third major concern is which rate or rates will replace LIBOR. Actually, these are all the three major concerns. One thing we should understand, in any other transition, let's say any other transition, naturally the central bank will hold the stick and then hit you and then possibly penalize you for not following its rules. But whereas in this case, it is not regulator driven. It is institutions and territories are preparing at different speeds. Actually, there are only the institution driven. Actually, it is not regulatory driven. Actually, so what I have to do? That's a basic question. That what I have to do? How I go about it? The first thing that you should, of course, at the macro level, what I should do? A enterprise-wide governance structure. First of all, you should understand LIBOR transition is here and knocking your door. It's hardly 90 days to go. And then naturally, it is a big risk sitting in your box. So basically, for the first thing is enterprise-wide governance structure. And then building a comprehensive inventory of exposure. Assessing the impact on developing a risk profile for all identified exposure. It is easier said than done. Building a paced roadmap based on the economic impact. These 4 points, if we start following, possibly the 90 days to go, in these 4 points, even if you start today, and what are actually, the first thing is, what is the risk in my books? There are so many corporates who actually, of course, earlier also I told, so many corporates who have a LIBOR embedded exposure, but unfortunately, they don't realize that they are running a LIBOR exposure. And then the basic thing is, these are all the desk level tasks. Actually, it is of course the governance level task, that 4 tasks. Desk level, what I should do, identify which products they use that reference LIBOR. Yes. First of all, that is what we are saying. Actually, take the inventory of all the exposure. Identify what amount of exposure these products have to LIBOR, including which mature after the end of 2021. Amend existing product to ensure that there is robust language in place and that sets out the steps to be taken or the interest rates to be applied in case no longer LIBOR is available. Yeah, there could be so many things. Possibly, yeah, let's say 100-year loan. Everybody knows 100-year loan. Now it is going to mature in 2095. Naturally, LIBOR is there. LIBOR is there. Actually, you are going to replace that LIBOR with the SOIFR. Actually, as simple as this. Ensure appropriate documentation, and then how to use RFRs and other alternatives to LIBOR if continuing to reference LIBOR. If there is a robust language, this is repeatedly being told, actually, robust language in place. And then inventory of relevant systems used. Actually, what is the kind of risk system that you are going to use? If the desk does this micro level planning, if it starts doing, possibly it is much easier to transit from LIBOR. So in Indian context, what has happened? Actually, that's a basic question. Actually, Indian context, what we have done. So basically, as is the case with any IBOR, that is any interbank offered rate. Every interbank offered rate, let's say even in Singapore or any country for that matter, they use that LIBOR. Actually. So basically, when the LIBOR is going to be discontinued, naturally, these IBORs also have to find their own way of doing things. That is where actually, now what has happened in India actually, the FIBIL MIFOR curve is an implied rupee interest rate curve derived from FIBIL forward premium curve and the USD LIBOR curve. It is being published in April 2018. This FIBIL MIFOR curve, it is actually computed over 6 months, 6 tenors right now, overnight, 1 month, 2 months, 3 months, 6 months, 12 months. This cessation of publication of dollar Libor will affect the publication of MIFOR also. Now, what we are going to have, we are going to have a FIBIL modified MIFOR card. That is one modified MIFOR card will be computed using the adjusted SOFR rate and the FIBIL forward premium rate. So basically, they are just substituting what is available in Libor with actually what is going to be available in SOFR. So the existing MIFOR, and then of course RBI has advised to cease using MIFOR in any event by December 31, 2021. So basically from 1st January onwards, you are not supposed to use MIFOR for writing a currency swap or for that matter, any other derivative product using a MIFOR. So what I am going to do actually, so basically now actually modified MIFOR. There are two MIFORs that will come. Of course, we'll modified MIFOR and existing MIFOR actually. So basically, it's only whatever the legacy transactions which will be used of the existing MIFOR and modified MIFOR for all the transactions that you are going to put in place from, let's say, 1st January 2022. Whether India has any risk on Libor transition, that's the one question actually. If you see the graph, it's about $570 billion external liability. I am talking only about the external liability that has been going up, and $570 billion by as of 30th June 2021. This $570 billion, let's say, it is let's say Libor plus spread, most of it is dollar denominated. 90%, 90% of India's external debt is dollar denominated. So basically, even if you take $500 billion, then naturally you are going to have, just because you are going to pay a higher quantum of interest rather than the earlier old Libor plus spread, the India Inc. is going to lose at least $1.5 billion per year because of the Libor transition, which nobody knows, actually nobody appreciates as of now. But this is the kind of embedded risk that is there because of the Libor transition. And then accounting standard, of course, there's nothing much to do. The four things that you should always think about is legal. How am I going to go from Libor to SOFR? Am I being offered the correct alternate reference rate that is available in the market? Whether my hedge and my loan are going to have the same alternate reference rate. Whether basically at the end of it, you should not have a loan on which actually SOFR is going to be the alternate reference rate, whereas the hedge is going to have some other alternate reference rate actually. That is where actually the entire problem comes actually. Now, in summary, what is that actually? The Libor transition, it is actually, I'm telling you, it is a distracting annoyance. There is no doubt about it actually. Distracting annoyance on the budget side to more like an enforcement action actually. Maybe as the day goes by, your management is going to say, just do it. We have run out of time. Spend whatever you must to resolve. I think this is going to be the message from the management at some point of time, possibly on December 30th, 2021, when actually possibly when the last day is going to knock on the door. So what we have to do, so first of all, of course, Rohit and Bhavin will be talking about the practical aspects and how you have to operationalize and what are the kind of challenges that they envisage. But as of Indian context, the one thing is actually talk to your bank and then first of all, find out your Libor exposure, A, and then find out what is the kind of ARR that you are going to use and talk to your bank about the ARR that they are going to use, and then fallback protocol, both in the derivatives as well as in the loan. These 4 points, if they do, naturally the transition is going to be much less painful. But otherwise, it is going to be a painful process for most of the corporates with Libor exposure. Thank you very much. And then, of course, we'll look forward to your questions later. Reena?
Thank you very much, Thaguji, for the insightful session. They say that, the problem rightly understood is half solved. now we have rightly understood what we are dealing with here. And now we know that SOFR it is. But now how to talk to the bank? What do we do next? Let us go to our second expert for the day. Now I would like to invite Mr. Rohit Joshi. He's a senior manager at TNP London, MBA from London Business School, and a chartered accountant. Having 17 years of experience in finance, risk and strategy, economic capital and risk framework, business case development, project management. He's an expert in Libor transition, again having experience in UK, India, Middle East, Asia, almost 20 other countries, implementing Libor transition for a lot of banks and corporates. We look forward to hear from you, Rohit. Over to you.
Thank you very much for that, Reena. Hello, everyone. Tyaguji has actually covered the topic fairly extensively and actually in a fair bit of depth and detail as well. I assume that's probably given you a very good context of what this involves and I suppose the extent of work that might need to be done in case you haven't already started that work. But maybe what I can do is go into a bit more depth. And before I do that, I believe I saw someone having raised their hand. No, it's come down again. That's not a problem. Okay, so what I was going to do in the next 15 minutes or 20 minutes or so was to maybe cover a bit more of the similar ground that Tyaguji has covered, but go into a bit more depth and talk specifically, or maybe try and decipher a bit more about technically what does the LIBOR transition mean? What do the specific differences between the LIBOR rate and the alternative reference rates mean? And following that, my colleague will dive a bit more deeper into what does it mean for US corporates and what can you think about. Let me go straight in and yeah, and I'll just explain what we'll talk about. But yeah, just reiterating what some of the things that Tyaguji has said. I mean, we've known LIBOR for a long time. It's been there, but in the last few years, we've seen that it's susceptible to manipulation. Regulators have understood it, and that's really why LIBOR is now going to be transitioned. And of course, for daily practitioners, for users on a day-to-day basis, exactly as Tyaguji has said, it has ended up being an annoyance. The transition of this rate has become an annoyance. It's become a big headache for lots of us to deal with on a day-to-day basis. But the reasons for transitioning them are fairly solid, and structurally it was a rate which was susceptible to a lot of manipulation. We had seen that manipulation happens, and ultimately that's to the detriment of final users. So it had to go. They again reiterating the specific dates, we know about it, but this December, in 3 months' time, is the big bang change date on 31st, after 31st of December. 4 major currency LIBORs will no longer be available. So in euros, in Swiss francs, in Japanese yen, and in pound sterling, GBP LIBORs will not be published after 31st of December this year. Likewise, for US dollars, we do know that the 2 of those 7 tenors, the 1 week and the 2 months, will not be published. But yes, I mean, I'm sure all of you are probably aware by now that the other 5 most popular tenors of USD LIBOR will continue to be published till June 2023. So the overnight 1 month, 3 months, 6 month, and 12 month will be. And naturally, that probably can lead to a bit of complacency in the market, saying, okay, great, it's still available, we don't need to do anything. But of course, that's not the case, because all the global regulators have been fairly clear that this extended period of a month, year and a half that's available for dollar LIBOR is purely to help the existing transactions to run off. They're not expecting to add new LIBOR-linked transactions to the existing stock after the end of this year. And hence, obviously, you need to be prepared that from 1st of January 2022, any new transaction that you foreign currency transaction that you end up doing, which is a variable rate and has to be linked to a reference rate, will have to be linked to the alternative reference rate, be it SONIA for pound sterling or SOFR for US dollars or whatever it is. So that's why it's actually fairly important for everyone to be aware of it and start thinking about it. In fact, now that we are entering the last 3 months of this process, if you're already thinking about next year's planning process or drawing down next year, or even starting conversations for drawing down in early January, February, early next year, you probably need to start thinking about this in SOFR or the alternative reference rate terms, not in LIBOR terms. So it's actually very important that this, in fact, as we've heard earlier as well, RBI has issued a clarification to all the banks within India that they need to follow the global timelines on it as well, which basically means that no new LIBOR referencing contracts from Jan 1st, 2022. That said, again, sorry, this timeline effectively reiterates that same message, saying that the main currencies of US LIBOR are going to be unavailable or will be discontinued after July 2020, June 2023. But at the end of December 2021, there won't be a lot of transactions that should be printed on USD LIBOR. And for GBP LIBOR, that same deadline actually had occurred back in end of March this year. So starting April this year, the SCA in the UK has been very clear that all new variable rate contracts in sterling should reference the alternative reference rate and not GBP LIBOR. So that process already happened for GBP LIBOR, will happen very soon for USD LIBOR and the other currencies as well. So yeah, effectively, summary is that there's a very limited time period where you can still reference LIBOR now. Moving on to some of the technical aspects now about LIBOR and the reference rates. What we thought would be useful is maybe to dive a bit more deeper into fundamentally what is changing between LIBOR and the alternative reference rate. And apologies if some of this is something you already know about, but it's well worth spending a bit of time on this one. There are various differences. First is effectively how are the calculations done, right? And LIBOR was done based on expert judgment based inputs, whereas the alternative reference rates in all cases are actually based on observed transactions in the market. And here the distinction, of course, comes up between the various currencies reference rates. Because obviously, as we know, LIBOR, although it was called one thing, it was actually 35 different rates, 5 currencies, 7 tenors, 35 different rates. Now that we are moving to this alternative reference rate regime, each of the administrations and governance on each of these reference rates has now been split up. So for 5 currencies, the governing bodies or the advisory bodies for reference rates has been split up. And that effectively means that there is slightly different ways of calculation and sourcing of data that's available for these reference rates. The next 2 points are actually the most critical about the differentiation. First one being the credit premium. And Maulik, I see your hand. I'll probably come back to you at the end of this slide. So the fundamental difference here is that LIBORs are actually an embedded interbank credit spread, which means that LIBOR includes a part of credit risk that's inherent in lending between banks. Whereas the alternative reference rates in pretty much all cases are near risk-free rates, which means it doesn't include the embedded credit risk premium for interbank lending as well. And this is very important to bear in mind, because when we move on to the alternative reference rate context, effectively, if LIBOR was at one particular level, we'll see that the alternative reference rate, just as a benchmark, ends up being at a slightly lower level. And these has implications on pricing. We'll come to that. The third point, again, very critical, LIBOR actually had term. They had, like as I said, 7 different tenors, ranging from overnight to all the way to 12 months. The alternative reference rates in all cases pretty much were overnight reference rates, or at least that was what was proposed as the most likely option for most of the reference rates. Over the period of time and in the last few months, actually, a term version of these reference rates is also available in some of the major currencies for sterling as well as in dollars. So there is a bit of an equivalence between LIBOR and a term alternative reference rate, but it's important to note that there is also the overnight version, and that's actually the pure form of the alternative reference rate that's supposed to be used. The term rate is effectively a derived number from the overnight rates, and it's actually very important that these overnight rates have become the anchoring benchmark on which everything else is tied. The next one is about the fixing. Of course, as we know, there are specific fixing dates for LIBOR when you give LIBOR loans. There are specific fixing dates, and on that, you do the fixing. And very importantly, from a borrower's point of view, you effectively know what your payment is going to be at the end of the interest period. So once the fixing is done, you exactly know how much cash flow is going to go out the door for a LIBOR linked loan in 1 month, 3 month, whatever the interest period happens to be. In the alternative reference rate, it actually depends on the reference rate you choose. If it's an overnight compounding, overnight simple reference rate, then you actually will not know what the interest payable is till the end of the period. Some of that problem is actually mitigated if a term reference rate is used, and we'll come to that as well. But the point here to make is there are actually different rates that can be used, and then there is a different application or time period when you would know the available, the amount of interest payable on it. And likewise, the settlement value is known upfront, whereas you would know the settlement value just like the fixing time. You would know the settlement value at a later point of time, if depending on the interest rate we choose. I'll pause here. Maulik, maybe I'll open it up to you. You had a question.
Rohit, we can take up all questions together at the end of the session.
Right. Let's do that then. Okay, I'll just plug on then.
Please.
Okay, cool. So let me then move on to one of the key differences that I highlighted in my earlier slide. The fundamental difference was the second one about the embedded interbank credit spread. And what this chart tries to do is illustrate what happens because of that, right? Here we have the light gray line, which is the equivalent of a 3-month compounded SOFR rate, which is the alternative reference rate. And the dark blue line is the 3-month dollar LIBOR rate. And here you can see that consistently the 3-month LIBOR is higher than the 3-month compounded SOFR. And that's inherently because of the fact that the LIBOR line includes interbank credit spread. So that's one thing that's going to be not included in any pricing that's done on SOFR, and hence the banks would obviously want to do something about it, which we'll talk about on the next slide if I can get to it. Yeah, here we go. So as I mentioned, right, because there is this interbank credit spread that's not included in LIBOR, there is obviously a question about, okay, so what happens when you switch to a different reference rate? Obviously, the banks and do not want to lose out on that part of the margin that would have inherently been a part of the benchmark, and then any margin they charge on top would also include that interbank credit spread. That, because that layer is now going away, ISDA, which is the International Swaps and Derivatives Association, had a very wide consultation about how do we deal with this issue, mainly from a derivatives perspective. And after very wide consultation, having inputs from everyone in the lot of participants in the market, they agreed that the best way to do is introduce a concept called a credit adjustment spread. So effectively this interbank credit spread that can be recovered for existing contracts where you have got LIBOR plus margin. Let's say LIBOR plus 4% margin was the current pricing. If that existing contract now needs to transition to a new SOFR-based world, then it can be SOFR plus a credit adjustment spread, which will account for the interbank credit risk, which is missing from SOFR, and then your margin, which can remain unchanged. So this credit adjustment spread can then effectively be charged in existing contracts, which are referencing LIBOR. Now, how do we fix this credit adjustment spread? So if we go back here, we'll see that the difference between the LIBOR and SOFR consistently lower, but the value keeps changing. So depending on any particular day we choose, the difference between the interbank credit spread could be very high or very low. So the best way to fix it, the decision in the industry was that we have to take effectively the median spread between these two curves over a reasonably long period of time. Decision ended up being using a 5-year data period. So effectively they've used almost 1,000 data points spanning 5 years. So starting from 5th of March 2020 and this year, going back 5 years, and using the median data point from them for each of the tenors to define what the credit adjustment spread should be. And this table on the left, top left here, gives those numbers. So for each of the different tenors for LIBOR that we've seen, by currency for US dollars, as we can see, for let's say a 3-month, the credit adjustment spread that should be added on top was determined to be 26 basis points. The same number for GBP would have been 11.9 basis points, and so on and so forth. So that's the fundamental concept of credit adjustment spread that's proposed to be added on. started off from ISDA for derivative contracts, but all the loan markets have also accepted it as reasonable proxy for the credit adjustment spread. And down here is just an example to show that if you've got a contract, existing contract, which goes beyond LIBOR expiry, and if you, for example, have a 6-month fixing, then the way it would work is that you would look at the adjusted SOFR, you would add the credit adjustment spread, which comes from the table up here, USD LIBOR 6-month, which is 43 basis points, to give you a total number of 49 basis points as your switched over reference rate or all-in price, the reference rate price that you would end up getting charged, versus a LIBOR. And in this case, we have taken a number as of 26th of March, which happened 6-month LIBOR happened to be 20 basis points. So effectively, it would seem that you end up having, as a borrower, having to pay a higher rate of almost 29 basis points compared to what you would have done because of LIBOR. The point to note here is that this difference arises because of the difference between the SOFR and LIBOR as of today, or as of the date of these numbers. Purely because we are in a low credit risk environment, we can see that this difference is low. If it was actually in a different case where SOFR actually, or the interest rate was much higher, the median difference wouldn't have been higher, and the overall potential increase in your pricing might not have seemed that higher. That said, this is the practical place where we are at. And if you do a as of or any particular day comparison, you'll always see a difference between the proposed SOFR plus credit adjustment spread versus the LIBOR of a particular day. Okay. Let me move on to the second part of the difference I had spoken about. Here we had talked about, what are the various flavors of alternative reference rate, or the various, and the main difference I had said is that the difference is in term, right? Where we had LIBOR was available in 7 tenors, whereas the main or the pure SOFR was available as an overnight rate, but that actually created issues. And especially from your perspective as borrowers, you would probably see that actually on a live basis, where unless you know what you're going to pay at the end of the term, you have a problem to manage your cash flows. If we have, for example, go with the pure definition of the alternative reference rate, which was compounded in arrears, then what would happen is that your alternative reference rate, the observation period for the reference rate would be, let's say, if you are here today, and if you have, and then let's say take a 3-month interest period example, then your observation period and interest period remain the same. You actually have to pay the interest on actually the same day when you know what the amount is, and that becomes a challenge for you. And then the next 5 options we have here are some variations to help solve this problem. What you could do is you could agree that you would know the interest payable at the end of the period, but you would actually make the payment slightly later, so slightly delay the payment. That's one option. The other option is a lockout option, where you lock out the observation period, so effectively leave a few days at the end of the interest period to help for you to manage your cash flows, and hence you would know your payment, let's say 4 days or 5 days before end of the month or end of the quarter, and the payment will happen actually on the end of quarter date. Alternatively, you could shift the observation period a few days so that you're looking back 3 days or 4 days, and then again, same principle applies. You would know the actual amount payable 4 days or 5 days before the end of the quarter, and you would pay it at the end of the quarter. So all of these issues are possible in case the in arrears option is chosen for the alternative reference rate. There is also another potential, which is called the in advance option, where you would know the interest rate available upfront, but for that the observation period has to shift. So the concept here is a last reset or a last recent. Again, these are some of the options developed in the market, where if the last reset option is used, you effectively look at previous quarters observed interest rates, use that to fix your payment period, the interest amount, and then charge it for the next period. So would work similar to a LIBOR, but the actual interest period, observation period, would be a previous period. And the last option, the last recent, similar concept, except that it would use a shorter time period rather than the full 3 months, because that potentially becomes much staler. And again, payment is available or known today, payment amount is known today, the payment is due end of the period. So these are all some of the permutations and combinations of what's available in the market, or how the market is trying to solve the problem of the fact that the alternative reference rate are compounded and only known at the end of the period. There's another option that's also available, which is called a term option, right? The term SOFR or the term SONIA as we know it. And it has actually received a little bit of a regulatory blessing as well. And I'll just move to the next slide, which explains a bit about the term SOFR concept. Now, term SOFR is a rate that has been developed or created by the Chicago Mercantile Exchange, the CME. That's been nominated as the official source for sourcing term SOFR by ARC. And CME has developed a methodology where effectively they take the overnight daily rates, the compounded daily overnight rates, and they look at the derivatives markets on SOFR, the futures markets for SOFR, to create a term structure. And based on that the published methodology, then they create a term SOFR rate, again available for 1 month, 3 month, 6 month tenor, and very soon 12-month tenor as well, and publish that in the market. So the alternative is to also be able to use this term SOFR rate. When this concept initially was being discussed, and because FCA and the UK has been leading in this process, when a term SONIA rate was developed for the sterling market, the FCA published a use case about when can this be used. They had published actually a very limited use case where they said we can only use it for discounting kind of trade, kind of trade finance kind of products where you need to know the rate upfront, or for very small customers who might not understand this concept of compounding. Now, when it comes to the US dollar and SOFR, the ARC, which is the governing body for dollar reference rates, has come up with a much wider use case, which means it actually could be used for a lot of the business loans, syndicated loans, middle market loans as well as for hedging cash exposures, or for any securitizations that are done with the underlying being term rates, etc. So the use case effectively for term SOFR is actually wider than what it was for term SONIA. And I guess I'll conclude by just summarizing what I've said in the last few slides, saying that when it was Libor, it was reasonably straightforward. Although flawed, it was easy. 5 currencies, 7 tenor, all coming from one source. Now we've got a lot of different options, a bit potential of a lot of confusion in terms of what are the types of rates. Some rates are in advance, some rates are in arrears. Whether in advance, what I've spoken about is this term reference rate from CME, term SOFR. But in addition to that, there are lots of other rates as well being provided by private service providers like Bloomberg, ICE, Ameribor, IHS Market. Again, all of them are trying to do basically what we mentioned earlier, try to recreate what Libor is trying to do. One point to note is that the regulators, both in the UK and US, have been very critical about these alternative reference rates, which are credit embedded. They really want to discourage the market from moving to one of them. They're saying if you want to use a term rate, then just use the term SOFR rate rather than any of these alternative reference rate, which are credit risk embedding. And then on the in arrears side, we also have this option of simple average, simple interest rate, or compounded interest rate. And then even compounded, there are lots of ways of calculating that compounded rate. So things can get fairly complicated. And I'm sure some of you are already aware of it, but probably just reiterating the message that things are fairly complex. And with that, I guess I'm going to hand it back to Rina, who might introduce our third speaker to take it from here on.
Thank you, Rohit. Thank you for the insightful session. So now we know that it is SOFR, and there is SONIA, and there is a credit adjustment spread, which is going to come on top of it. It's going to be in arrears or in advance. They say that it is wise to learn from your experience, but it is even wiser to learn from the experience of others. So with this, I would like to invite our third speaker, Mr. Bhavin Shah. He's also again an expert in Libor transition. He holds a BSc degree in management science with Manchester University. He's also a chartered accountant. And with 23 years of experience in corporate products, portfolio management across the life cycle of lending and driving improvement in the customer's journey. In his Libor transition, he has also again worked with various banks and corporates across Middle East, Asia, Europe, UK. Let us learn practical challenges of Libor transition from Bhavin. Over to you, Bhavin.
Thank you, Reena, and thank you for inviting us to talk to your members here. So Libor transition started in 2013. You've heard the reasons why it started, but it's taken a long, long time for us to get where we are now. And the main reason for that was the regulators didn't want to intervene. They wanted it to be a market-led transition. And when they said it was market-led, it was mainly the derivatives market, which is the largest market which uses Libor. And it's a very complex market as well. But it didn't really include the end users like yourselves. So this is why this has taken a long, long time to get to where we are. And we've seen some significant changes in the last 18 months or so, and we've touched on some of these before. So the transition has really been driven by the banks. They have been designing what the new rates should be, what the new product should be, and all that. And again, because it was driven by the derivatives parts of the banks, the products were sometimes not fit for purpose for the end user customer, the corporate customer. And so the voice of the end customer was not really at the table. When I got involved in Libor transition about 2.5 years ago, I got involved in the Bank of England risk-free rate working groups and started to talk to people from the Bank of England and start to bring the voice of the customer in. At that stage, they had a consultation paper where they were talking about what the new rates would be, and it would just be an overnight rate. There will be no term rates at all. And very quickly, I brought some voice of the customer. So when I was working for Royal Bank of Scotland and NatWest, I was talking to their CFOs and treasurers and bringing the voice back to why would they need to use a term rate, and bringing that back to the Bank of England, bringing that back to the risk-free rate working group. And very quickly after that, they set up a term SONIA working group to really understand, okay, we're hearing that corporate treasurers, CFOs want a term rate. Why do they need it? What are the kind of products they would use it for? And as Rohit mentioned, we would be using this for a limited use case in the UK market for the term SONIA rate. Thereafter, the US market has realized that actually there's a much broader use case, and to really get the whole market moving, we need to broaden the use case for the term rate, which is why the term SOFR rate is now in use and has been for the last couple of months or so. Through the experience of working with the bank and then working with True North partners, we've been advising banks how to do this, but we're also talking to a lot of customers, what should they be thinking about? So we bring a lot of subject matter expertise to this to help you look at both sides of the coin. And finally, before I move into the next slide, is we've seen different timelines for the different currencies. So for example, sterling, Swiss francs, Libor rates will go by the end of this year, whereas US dollar will carry on till the middle of 2023. And that really goes back to the fact that this was a market-driven change and each market was doing their own thing. There really wasn't any coordination up until about 2 years ago, where they started saying, well, actually, this is a global market. We need to coordinate our activities. So that's a little bit of a backdrop as to why it's fragmented, what our experience is. Rohit, if we can move to the next slide. Thank you. So what should you be thinking about when you start thinking about the practical challenges of transition? From our experience, the legal contract is one of the most important things. So do you understand where all your legal contracts are, where you might have Libor exposure? So obviously your financial instruments are an obvious place for you to go and get your Libor exposure. But what about your supplier contracts? There may be penalty clauses in there which reference Libor. You may have intercompany transactions where you reference Libor. So really getting an inventory of all your legal documents where you may be referencing Libor is a really, really important step. And then once you know where you have Libor, what are you going to do about it? Operationally, it's a real challenge because most systems, not only banks, but corporate systems, are based on a term rate where you put a rate for 3 months, 6 months. When you go to an overnight rate, very, very different system requirements are needed. The banks have really struggled to upgrade their systems to do this. And the corporate systems are probably behind the bank systems as well. So if you use a treasury management system, you need to be talking to your provider to say, how will my system adopt to new rates? It's really, really important that you understand that. And it's not as simple as it sounds. Now, I think the advent of term software and the wider use case will help because operationally it works very, very similarly to Libor, even though from a pricing perspective and all that, it is different. But from an operational perspective, it's much similar to Libor. So what is your bank offering you as alternatives for your financial instruments, for your internal documents, intercompany and all that? What kind of Libor rate are you using? Can you use a term software rate? Do you need to use an overnight rate? And if you do that, how do you start accruing for interest and things like that on an overnight basis? That will have significant system implications. So you need to think through those. Obviously, if you had an overnight rate, forecasting what your interest payments will be, future cash flows will be much, much harder. Rohit went through some of the technicalities of the different rates and how we do it. But again, as you're starting to budget and think about next year and how do you forecast what the business needs will be, you need to think about what kind of rates will you be using, and can you use those to forecast your budgets and cash flows for next year. And then finally, we talked about the credit adjustment spread. So that historically has been embedded within the Libor rate. And as you've seen in a few of the charts, the difference between the Libor rate and the risk-free rates varies depending on the economic situation, depending on the stress the banks are under. Previously, that cost would have been passed on directly to you. Now that cost is not embedded. So in the transition, there's a credit adjustment spread. And Rohit has explained the difference between how they came up with the ISDA credit adjustment spread and what the spot rates would be now. But also going forward, because you will only have the alternative rate, so SOFR, for example, and then a margin on top of that, many banks will start embedding this credit adjustment spread within the bank margin. Now, if you think about what that rate is meant to do, it's meant to move with the way the market moves. How will the bank capture that? Presently, the thinking is it's just going to be a margin that's captured in at a point in time. That could be relatively higher or lower to the average rate as we move down the market, but you don't know. So that's something that you need to be aware of when you start negotiating your contracts, negotiating the pricing, is be aware that there's an additional element in the margin that the bank would be trying to recoup for the interbank rates. And then finally, how aware are people within your organization about this transition? So if your supplier, if you're someone who's dealing with the suppliers and is negotiating contracts and they keep using Libor, that's not really going to help because you need to move away from that. So really spreading the word internally in the organization, but also to your boards and senior decision makers. Do they understand the risks associated with this? Many of the large companies in the FTSE 100 that I was talking to, some of the large supermarkets, for example, had set up project teams where they would go and present to the boards, and the boards would then have to disclose this risk in the financial statements and all that. So it's critical that senior members of the organization to people managing the day-to-day business understand what's going on and what are the options that are coming through to manage the risks around the transition. We'll go to the next slide. So again, I've touched on what are the key aspects. Legal contracts, very, very critical. Do you have legal counsel internally that you can rely on to help you with that? Or will you be relying on the bank's legal counsel, who obviously will have the bank's interests at heart? So very, very important that you make sure that you're covered from a legal perspective and understand the different conventions that the banks might approach you with, the overnight rate, So whether it's daily compounded, simple interest, whether it's a term rate, what the credit adjustment spread or the increase in margin is, understanding that. As I said, from an operational perspective, really, really important that you understand how your systems and your processes can cope with a change in rate. An overnight rate is not the same as a term rate. One of the banks we've been working with, we're about 6 months behind where we thought we would be from a systems upgrade perspective. So your treasury management systems, if you use those, are critical that you talk to the vendor ASAP and understand whether they're upgrading the systems to deal with daily rates. And then liquidity management, right? How will you change the process of how you forecast cash flows from individual transactions to managing your liquidity positions and all those? So really, really important you understand the choices being made in terms of the rates being used and how you can leverage this as well. And then finally, we talked about the economic impact assessment. So if you have some major facilities that are due to be renewed next year, because of the change in the rate, is there going to be an economic impact that you have to budget into budget for? Let's go to the next slide, Rohit. So what are True North Partners credentials? And I think one of the questions came up about wanting contact details. We have a bunch of people that have been involved across the finance industry, from accountants to consultants to people who've worked in banks that really understand the end-to-end of risk management. And obviously, Libor transition is one of the key risks impacting the industry at the moment. But we have a real understanding of capital management risks, credit risks, all these different profiles. So we have hands-on content-driven people who can really help you if you need to quickly tackle the challenges you face with Libor transition. We can help you quickly design a program that you can then have a discussion with your financial institutions. As I said, we have subject matter experts who've been involved in regulatory bodies, presenting at forums. And so we have connections and contacts within the industry, so ahead of all the change that's going on, and can really help you plan for the future. And as I said, we cover a wide range of topics. So Libor transition is obviously the key at the moment, but through our interactions, we may understand that there may be other risk management issues you may have that we can help you with as well. I think the next page, Rohit, has some examples of some of the expertise we have. And then the next page has some tombstones of experience we have on dealing with these. What I'll do is we'll leave this up here. And I know there's a bunch of questions that have come in, so perhaps we can go to those questions now, Reena.
Thank you, Bhavin. Thank you for the wonderful session. You all have been lovely audience with the patient hearing. As Bhavin said, we now open the floor to the questions. You can type your questions into the Q&A, and then we'll take up the questions. We give 2 minutes to audience to put on their questions.
Reena, one of the questions that came in earlier was SOFR is cheaper by 52% in base value. So maybe I can answer that question.
Yes, please.
And the reason that there's twofold. One is we spoke about the interbank credit risk not being included in the SOFR rate. So because of that, SOFR is obviously going to be cheaper than the Libor rate. The other response is, Rohit touched on that, we're in a very low credit risk environment at the moment. And so the SOFR rate is at very, very low levels, whereas Libor gets impacted by things like COVID. What does that do to the liquidity in the market and all that? So SOFR does not capture some of these economic movements that Libor has been capturing. So between that and the interbank risk, this is why SOFR is considerably cheaper than Libor on a spot basis.
There's one more question, Bhavin. which says whether the ISDA spread adjustment is fixed.
Rohit, do you want to take that?
Yes, please.
If I can unmute myself, yeah. So yes, Rina, to answer your question, the ISDA spread adjustment has been fixed. It is effectively a one-time fixing that was done to find out the difference between the LIBOR and the SOFR curves. The expectation is that this credit adjustment spread should be used for existing contracts that need to transition. For any new contracts that happen, the interbank credit risk should be embedded in the margin that the banks potentially end up charging to the clients.
There's one more question which says, how do RFR-based loans work? Yeah, in case Tyaguji may want to take it up.
Maybe let me start with that. So I worked on the first Sonia loan in the UK market with National Express, and obviously we've been helping design some products for banks that we work with. So it depends on the reference rate you use. Most of the major banks want to create optionality, so having the daily rate available and all that. If you're using a daily rate, you can use two methodologies, which there's compounded interest methodology, which is primarily used in the UK market, is mathematically more accurate in capturing the time value of money if you're compounding a daily rate over a set period, so 30 days, 60 days, 90 days. The US market has gone towards a simple interest methodology where interest is charged on a daily basis, and at the end of the period, you just add up the interest. Primarily because that's simpler to understand and simpler for systems to process as well. So we've designed products using either of those methodologies for either of those currencies. Obviously, now you have the term rate available as well. So that, like I said, works very similarly to LIBOR from an operational perspective. But pricing on all these products will be very different to how you price on LIBOR. So for example, if you have an existing loan where the margin is LIBOR plus 3%, if you were to do a new transaction in January, what the bank will offer you will be SOFR, if it's a US dollar transaction, SOFR plus margin. But within that margin, you won't be able to compare the two margins because the other margin will include this credit risk element, the interbank credit risk element that the bank has to capture within its margin. So pricing will look different between the two products, LIBOR and alternative reference rates. If you're using a daily rate, operationally it'll look different. So for example, if you do a compound rate, the market convention at the moment is a 5-day look back. So rather than starting with the rate as of today, if you sign the contract today, they'll use the rate from 5 business days before, because at the end of the period, it gives them 5 business days to notify the customer what the interest payment will be. But upfront, you won't know what the interest cost will be because that will be calculated towards the end of that period. So very important that you understand the mechanics of the different rates and how that would impact the product, and how that would impact you, the notification to you for what your interest payments would be, and how you'd be able to project what the payments will be. I don't know if Rohit or Tyaguji, you want to add anything to that?
Pavan, I think you've covered it.
Yeah, absolutely.
Tyaguji, there is one question from the India's perspective, that what happens to my existing hedges?
That is what we were telling, actually, basically existing hedges as well as the existing loans, they both should be transited to the same alternate reference rate, actually. That is when actually hedge will be of use, actually. That's a basic thing. Otherwise, you will end up having another risk in your book, actually. So, say mostly the bank actually understands, actually. Let us say you have a ECB And then against which actually basically I was mentioning about the floating rate ECB. Actually, that is what normally most of the Indian corporates have, floating rate ECB, and then you have a IRS, dollar IRS, where actually you have received floating and paying fixed. Let's put it like this. So when you are receiving fixed in the hedge, and when you are paying floating in the ECB, naturally it matches each other, and the end of it actually you are ending up. That is how you have hedged your interest rate risk. Now, when you actually basically you don't the transition cannot happen to different reference rates, and then you end up having risk in hedge as well as in the loan. So basically, it should be seen both the loan as well as the hedge should be transitioned to the same reference rate, alternate reference rate.
Thank you. There's one simple question which says, we would like to know whether all the ARRs are being published currently.
Yeah, absolutely. Yeah, definitely.
Yeah, available, right?
And then bond market globally, actually, another question is there.
Yes.
I think nothing is going to happen to the bond market, actually. I think bond market is going to be on its own, actually. At the end of it, actually, actually, Libor transition is not going to give rise to any inflation as such. But the only thing is, the interest cost for the corporates is definitely going to go higher, actually. That's one thing. And then bank overhead cost is going to go higher, actually. And then bond market, actually, as far as the interest rates are concerned, I don't think it is going to impact interest rates per se. SOFR is going to be at, let's say, overnight SOFR is going to be at 0.05% as of now, and I think it is going to continue like that. Actually, in this zero interest rate regime, actually, possibly that 0.05 SOFR seems to be there for a long time, actually, even if the taper happens, and that's it.
And just to add to that, all bonds will need to transition to alternative reference rates. They cannot stay on Libor. And in fact, the bond market was one of the first cash markets to move to using the daily rate. So that's one difference, that the term rate will not be available for bonds. If you were issuing bonds, the market is mainly using the daily overnight rate.
There's one more question on the pricing of the spread. Can pricing also differ from bank A to bank B based on their own respective assessment of risk margin spreads over so far?
So yes, I can maybe take that, and then Rohit, if you want to jump in. The short answer is yes, because each bank will have their own assessment of what their funding costs are, what their funding profile is. Even the banks are still trying to understand from an interbank credit risk perspective, how will they really capture this? Because previously they were used to it being captured in the Libor rate, so they didn't have to separate that and think about it separately. But now they're thinking about that. So for some of the transactions we're seeing in the banks we're advising, some banks are using the ISDA credit adjustment spread. Some other banks are using their own calculated credit adjustment spread. So already there's a difference we're seeing in the market. And definitely going forward, if another element is baked into the pricing margin, I'm sure banks will approach that in different ways. Rohit, I don't know if you want to add something.
Yeah, the only other thing to add is it really would depend on their bank's internal perception of their cost of funds. That would be the reason why they would have a slightly different differences in the margins that they charge. The benchmark or something to serve as a guideline for the rest of the whole market effectively is the credit adjustment spreads that we looked at earlier. That effectively becomes our starting point, and then it could be slightly above, shouldn't be above, in most cases it's probably likely to be below, if at all, depending on the bank's perception of their cost of funds.
Thank you. I think we have taken up most of the questions. We conclude the session here. I will hand it over to DRIP team for the vote of thanks. Vanita.
Hello.
Yes, Vanita.
Hi.
Thank you to all our speakers. I am sure this was an insightful session. We saw a lot of questions, might have solved a lot of problems. And if at all any of our viewers have any questions, they could write to us and we'll happily connect them to our speakers. We'll send it to them to our speakers and they could get back to you. I would also like to thank all our viewers for participating in today's webinar. You'll receive a short survey once we end this session. Request you all to share your valuable feedback and topics that you want to hear from us. It is important for DRIP to hear from you so that we could continue to organize a knowledgeable session like these for our exporting community. Also, please follow us on social media to stay in touch with the company. You can follow our blogs and newsletter for recent trade updates, insight on foreign trade related matters. For our Zoom and LinkedIn audience, you can watch all our previous webinars on our YouTube channel also. To subscribe to our YouTube channel, please click on the link provided in the chat section. Have a great evening. Goodbye, and please stay safe.
Thank you.
Thank you.
Thank you.
Thank you, everyone.